Hello, everyone, and welcome to a new episode of our podcast at the Green Automation. Today we have Stuart, who is going to discuss with us some of the latest news and trends in the financial industry. Stuart, thank you very much for coming on board and being a guest today. And let's just get started. Why don't you introduce yourself?
Sounds good, Richard. Thanks for having me. My name is Stuart Kruse. I run an RIA called Cruz Asset Management. We are an independent RIA, not a broker dealer affiliated. Little background on me: I have an engineering degree, undergrad, and MBA in finance and in game theory. So we do a lot of mathematical modeling here. It's a lot of quant-driven stuff within our firm. We feel, and some of the research suggests that making those kind of decisions using math and statistics lead to better outcomes. So that's kind of the underlying premise of our firm.
All right, that sounds really interesting. Not everybody does that, but we hear of funds usually using quant.
Yeah.
So that's really interesting. Tell us about your company a little bit. Why did you launch it? When did you launch it? And how do you work with clients?
Yeah, so it, I think it's interesting how I launched it anyway. I was working at Bear Stearns and before that Lehman Brothers. Um, and when I got into the industry, which was in the late 90s, and I've been toying around with a book, like who hasn't written a book, but I have a book that was potentially coming out called License to Steal. And this sets the stage. And the reason for the book title was when I passed my Series 7 to get my brokerage license to enable me to trade and sell stocks and things like that. When I passed, one
Yeah.
of these big brokers said, "Hey, did you pass?" I said, "Yes." And he said, "Congratulations, you have a license to steal." Meaning I can steal money from my clients by just giving them ideas and whatnot and take money away from them. And that was his mindset. And that's how he made a lot of money. And that's not the mindset I was going after at all. Hopefully you're there to try and help your clients, not steal from them. You want
Yeah.
to be a resource. You want to be an asset regardless of your fees. You want to be paying for yourself. Like you want to be value add. If you were to fire a client, you want them upset that they no
Yeah.
longer can access you, right? So I wasn't happy with that whole phrase and terminology and the mindset that was going into the old brokers in the late 90s and whatnot. And so the more I was in the business, the more it was about that making money. I had a manager come out one time and just like literally scream across the boardroom like, "We need to put all our clients on margin." Clearly he was getting paid to be on margin, right? There's no risk from the brokerage firm if you put your clients on margin because they have 2 to 1 of the assets to cover any kind of debt they have outstanding. So there's literally no risk. They can just charge an out of proportion market rate, maybe 9% when they're paying 4, and make money. So of course the manager wants clients on margin. Is that the best thing for my clients? No. So that whole mindset, you have all the headlines with Wells Fargo's opening up accounts that are fake. Like that whole mindset was rough on what I was trying to do. So I opened up my own firm. Prior to that, I noticed it doesn't take a lot to notice that most money managers underperform the S&P 500,
Yeah.
right? Doesn't take a lot to notice, no matter how you slice it up, analyst recommendations tend to be no better than statistical noise. As an engineer, I've built hundreds of models over my lifetime. And if one thing I joke about, which is absolutely true, is if I'm going to build a model on something, the one thing I know about this model is it's going to be wrong. That's all I know about this model. It's going to be wrong. If I am an airlines analyst and I have to put in fuel prices and vacation prices and different routes and interest rates, and I have a bunch of unknowns coming into a model, and out the other side I have a known earnings.
Yeah.
No. No. You don't put 12 unknowns into a model and get a known outcome. Like that just doesn't happen. So trying to rely on those resources I thought was going to be challenging. So I built a quantitative model. I said if I were to buy stocks, I would use math. And what characteristics of companies tend to lead towards outperformance? Does buying low PE stocks work or does it not work? I don't know. Do the work, do the math. Does buying accelerated earnings worth or not? Accelerated dividends? Who knows? Like, I don't know. Does all Warren Buffett's strategies work or do they not? I don't know. So I did the work. And I found dozens of characteristics that tend to work over time. And so I built a quant strategy. It was working great. And so I launched my own firm because I wasn't relying on the analysts, and I can't compete in that market, and I don't even want to compete in that market. So we went the other direction is really what happened. So I launched my firm in 2007, right before the financial crisis. Great timing.
Yep.
It was really
Yes.
fantastic timing. I was at Bear Stearns at the time. I left in January. Little history lesson. Early in January, Bear Stearns was at an all-time high. I left 2 days after the peak of the stock price. A couple of months later, a couple of their mortgage-backed securities hedge funds that Bear Stearns had, they went from being valued at 99 cents on the dollar to being valued at 0 cents on the dollar in 24 hours. And
Yep.
people were scratching their heads like, what happened? And it kind of volleyed back and forth, but still nothing really came out for months after that. But people were starting to panic a little bit, like, why did these two mortgage-backed hedge funds go out of business? Like, it doesn't really make any sense yet. I had old clients saying, hey, is my money okay at Bear Stearns? And I was like, yeah, it's going to be fine. I wish I could tell you it wasn't. You'd have to bring it over to me, but it's segregated, but it's fine. It'll be okay. Like, your investment accounts are fine. But then it got worse. The mortgage-backed security spiraled down, and that hedge funds started taking down Bear Stearns and Lehman Brothers one at a time, and then the Fed stepped in with TARP money, right? So, but I was already out of that. I wasn't forced out. I had already left. So I got to see this from the sidelines going, it looked like I was crazy leaving 2 days after the peak of the stock price. And then fast forward a few months later, when Bear Stearns was about to go out of business, I looked like the Rock of Gibraltar, Mr. Stability. So anyway, that's my origin story of starting Cruz Asset Management.
All right. So that was some time ago, 2007, 2008. Yeah. Let's jump into today. What do you see in the financial service today? Let's say compared to 15 years ago, how we made improvements and how we manage funds. What's the status of the financial services?
Yeah, so I've taken I think a relatively different path, and we talked a little bit before the show started about potentially AI and whatnot, and obviously it's going to be big in all facts of life, just like the internet was big back in the late 90s. We didn't know how internet was going to change everything. We knew it was going to change everything. It did change everything, and it changed things in ways that we weren't expecting. I think mostly for the better. I think AI is going to be roughly similar. We're not going to fully understand it, what direction it's going to take us just yet. But what I do believe is that in the financial services, our clients are going to want to talk to people. And so while, just like in every business, while some of us are going to some of the work is going to be potentially replaced by AI, and I've dabbled in it a little bit, so I know enough about it to be dangerous. It's not going to replace the need for the customer interface at all, I don't think, in my opinion. I think I've got enough clients that are so uncomfortable with the concept of finance and money and investing that they want somebody across the table from them that they can trust that's going to be the interpreter and the arbitrator of AI and all the technology. And so I think our field is, I don't say safe, but it's still pretty solid. But that doesn't really answer your question about how I think things are going to change. And we've adapted what I think is a pretty interesting model more recently. So when I started my company, I was very, very narrow. I'm all quant all the time. Like, can I build the best quantitative strategies so that I can invest your money the most efficient way possible so that I am taking on the least amount of risk for the reward you're okay with, or what have you, and just I'm going deep down that path. Okay, that's a strategy, but as I'm building my business and I'm working with clients at You start off with a few $100,000 and then a few $1,000,000 and then higher up, and then these clients that might have 5, 10, $20 million now. Okay, I can talk to them. Maybe my strategy is better than Goldman's or Morgan's or whomever. Maybe they can get their head around. If I can convince them that I might make 1% or 2% a year, maybe better, more, I can outperform. It's still speculative, but maybe they'll give me a shot. Those people, even people with a few $1,000,000, they need more than that. They absolutely need more than that. And right now the model is, as the client's sitting in the middle, and the client has to talk to the wealth advisor. And then the client has to talk to the insurance guy. And then the client has to talk to the CPA. And the client has to talk to his estate attorney. And then if he's running a business, he's got business people he's got to talk to. And then he's got to do estate planning. So he's the one, he or she, is the one sitting in the middle, being the arbitrator between everything. And quite often what they'll do is they'll say, hey, I need, if I have an idea, then they'll say, I need to run it by my CPA. So I tell the client hires me because they're not financial experts. They are trying to explain to the CPA this financial package. Something gets lost probably in the translation.
Yeah.
CPA goes, I don't really understand what you're saying. We're not doing it. Because the CPA needs to look out for the client. So we've flipped that model to some extent. So instead of our client sitting in the middle being the arbitrator for everything, we say, Mr. Client, who's your CPA? We would really love to work with that person. The CPA will say, Mr. CPA, we have a common client, Mr. Smith. We are going to present to our client a bunch of other strategies, and we're going to use a team-based approach to optimize our client's wealth. And what we call this is a virtual family office. So I'm sure you're familiar with the family office concept. And
Yes.
that came reportedly from the Rockefellers, where they have so much money that they need to hire a team of financial professionals to look after their wealth. So when you look at current family offices, some of those payrolls are $10 million a year. So you have to have a $500 billion net worth in order to afford a true family office, in order for it to make sense. But a guy with $5, $10, $20 million doesn't have that ability to hire that entire group of professionals, but they still need some of those services some of the time. And it's still in their best interest if those professionals are working together.
Yep.
What we have done is we've said, all right, we're going to grab a group of professionals in a team-based approach so that we can now provide the client, Mr. Smith, Mr. Jones, Mrs. Jones, a team-based approach. So you say, Mr. CPA, we have experts in a variety of different proactive tax mitigation strategies. You are more compliant for the most part. Most CPAs are like, give me your numbers, I'll tell you how much you owe, and I'll charge you. And the client expects the CPA to be much more proactive, and the CPA will tell them about structures on better tax formation. Should I be an S Corp? Should I be a C Corp? Should I be an LLC? Should I convert to the Roth? More structural work. But if there are tax mitigation strategies out there, he's not going to be in tune to literally the 80,000 pages of the IRS code. So we bring in specialists that handle those things, and I'll say, Mr. CPA, how is this strategy for Mr. Jones? How are these 4 strategies good for Mr. Jones? We're going to have you talk to these 4 specialists. They're going to tell you all the tax forms, make sure that it makes sense for Mr. Jones and for his situation. You know more about his situation than anybody, and we're going to work together. Oh, Mr. Jones is selling his business in 1 to 3, 5 years? We have valuation people that can come in. We have M&A people that can come in. We have business consultants. We've got estate planning lawyers that can come in and reposition the company to take some assets out of your estate now where they have low valuation, so that when they grow, they're not part of your estate and you're not subject to state taxes down the road. We are working together as a team on behalf of Mr. and Mrs. Jones through the CPA, so that we are all working together and we say, dear Mr. Jones, Mr. Client, here's what we recommend as a group, as your virtual family office. So we have negotiated and decided what might be the optimal strategy, speaking in our financeese, and presented that solution to the client. That, I think, is a better model, and that's what we've kind of adopted.
So how is the reception from your clients about this model?
I mean, the clients that are in it, they love it. It's interesting talking to CPAs. Some, CPAs are, not to be too stereotypical, but I'm an engineer too, so I've a little set in my ways, right?
Yeah.
As are CPAs, they tend to be that way. And so if they've done something for their whole life a particular way, they're a little resistant to change. I'm happy filling out these tax forms and telling my clients what they need. I'm happy to give them some advice, but I don't want to delve into all this other stuff.
Mm-hmm.
We do help them and teach them how to get paid for being of a higher value, because the clients want this extra value. And these are real life cases. I have a client that sold $1 million, $1.5 million worth of company stock. She had a $500 tax bill, $500,000 tax bill.
Yeah.
And I reduced that $500,000 to about $100,000. So I saved $400,000 on her tax bill. CPA probably would not have done that. They would have just said, you owe $500K. You sold $1.5 million, take your $1 million and be happy about it. I said, no, there are some other things we can do. So now you've saved the client $400,000. The client's probably okay with paying a few extra dollars to the CPA for that work. They, in fact, probably are dying to pay the CPA extra for that work so that I can save that money. So the CPAs who have raised their hand and said, yes, I want to be more proactive. I want to give my best clients the best possible solution. I love this team-based approach. They have also loved it too. I'm not here to say what's right or wrong. Plenty of people are like, I'm good with what I'm doing. I don't need to reinvent the wheel. I'm happy. I found my niche. Great. That's great. The clients that have gotten this one-stop shop and virtual family office were like, oh, I can go to my CPA and his partner and say, what do you need? I need a cost segment specialist. I need an estate planning lawyer. I already got one. We work with that person. We fill in a gap. You already got a person you love? Great. Use that person. You trust him, you love him. He's been with you for 10 years, 20 years, even better. He's part of the team now. We are team-based players. Whatever's best for the client, that's the solution. So my experience is they've loved it. It's been a different conversation, much different conversation.
Great. That's great to hear. Usually there are some challenges to push some new ideas or solutions to the clients, especially if they can be a little bit reticent and when it comes to their money, even more. But I'm glad to hear that it's being received well by your clients.
Yeah.
Let's change a little bit the subject for a second. You mentioned using quant, and are you using algorithms to support your quant investment decisions?
Yes. Answer is yes. Yeah.
So when we talk about algorithms, with AI being in full force right now, is that a big part of your algorithms as well, where AI is being leveraged to support the decision-making process?
For us, in spite of the fact that I'm quant heavy, no. And I'll say that in the sense that the research for the research that you're looking at for quantitative strategies, machine learning, AI, going down the road, you're in order to make these investment decisions, you're adding marginal benefit. And the reason, and I don't know this to be true, this is just a theory. The reason that I think is the stock market itself, and Ray Dalio obviously made a huge living and made his mark doing this by building systems and decision trees in place for his hedge fund, which is incredible. And I've read his multiple books, and it's wonderful to see. But for the most part, the way we've been using it, it's these extra layers are marginal at best, in the sense that what comes up now and what was in the previous sample set tends to not be as applicable to what we're about to see. There are
Okay.
parallels, but to extract the value out of it and say, oh, this was just like 2007, 2008. But it kind of
No.
wasn't, and the market doesn't really react the same way every single time. So in some ways you hear the phrase, it's different this time, are the most expensive words on Wall Street. Like, oh, this is going to change everything. And like, will AI change it? Will NVIDIA, that's trading at 44 times sales right now, is that, or Tesla that's trading at these, that was trading at really, really high automobile numbers and trading like a
Yep.
tech company, ultimately, will these companies, are they different this time? Or are all of the companies going to go back to trading at more normal multiples? Just like we saw in the tech heyday, all of these high level companies were trading at hundreds times PE, thousands times PE, trading at eyeballs, trading at, and at some point you're like, it's not different. The company's gonna have to make money, and you're only gonna be paying so much for a dollar of earnings.
Yep.
That's it, like that. Now we might have an inflated valuation for a period of time, but so on some levels it's never different. On other cases, when you're trying to find the patterns in the stock market and what's happening, how you apply that sample and the current data can be misleading. So it's hard when you're taking out a sample data. So the marginal benefit has been yet to be played out on actual returns on the stock market, is what I'm saying.
So even though we have the most advanced technology in the world now, we are still going back to the traditional.
Still can't predict where the stock market's going on a day-to-day basis. Like I know every single, like you pick a large tech company, whether they're in finance or not, you've got hundreds of data scientists trying to figure out ways, and they're doing it in their spare time. Can I figure out ways to predict where the stock market's going? No, they can't do it. So
Everybody wants that
everybody
because
wants that, right? It's free money.
uh,
It's literally free money, so it hasn't happened yet.
yeah, I remember when I used to work at large banks. That was in 1995 to 2000. Um, we all wanted to find that magic
Yeah.
equation that would tell us what the price of the company would be the next day or the next week or month. So it's not like it's new. We have always been trying to figure
Yeah.
out a way to um, forecast ahead of time, which analysts do all the time. They forecast the upcoming earnings, they forecast the upcoming valuation, and the price of a stock ahead of time.
They try.
Uh, they try,
They
yes,
try.
yes, but they keep trying.
Right.
Um, and I remember working with the fundamentals, but also using candlesticks and other type of
Yeah,
strategies
yeah.
to
Technical strategies that.
technical analysis and whatnot, um, and to see what's the future of the stock price. Sometimes it works, sometimes it doesn't. And I feel like we haven't really made any progress in being able to tangibly uh, forecast the direction of a stock price in the future without making some large errors.
Yeah.
And earlier you were talking about samples. A sample can be small, can be large, but because we have millions of samples of price points in the past from the past. We can link that to all the events that have happened: economy, social, wars, the heat waves, anything like that. But we're still not capable of finding a path to a real forecasting model. And I would think that with the advancement of AI and the capacity of AI to work through millions, if not billions of samples, we would be able to be more capable of forecasting the trends of a stock price. But it doesn't seem like it's the case at this point.
It hasn't. I mean, you would think that that would be the case. I mean, to your point, there's so many data sets. Like I think, what if Facebook was reported to have 50,000 data points on each person, or some ridiculous number like that, in order to, be able to send the algorithms to them. And so we have at least as many data points on different stock prices and where it's going to go. But
Yeah,
you're right. We haven't. Some hedge funds would try and take aerial shots of Walmart parking lots to look at how many cars were in the retail shops, so you could see, those kind of things. And those potentially were leading indicators. And that all is kind of dried up to some extent, right? It's what tends to work. Like to your point, like you'll have technical indicators that will work short term. So momentum, you can trade. I'm not taking any risk home overnight. I'm going to close out my trades overnight, and I don't have to worry
Yep.
about these things. But what seems to happen every so often is there'll be a 2 or 3 sigma event, and it'll clean somebody's clock out, and that's why day traders go out of business more than 90% in a year.
Yep.
That's why more than 80 or 90% of hedge funds go out of business every single year. What does work is still the Warren Buffett strategy of, I don't know what's going to happen in 3 days, 3 weeks, 3 months, or maybe even 3 years. But if I buy a value-based company that is doing a good product and it is undervalued,
Yep.
I'm pretty sure in 10 years, I'm going to get paid back. And that's a little bit what the data says. Like if you're looking at the markets right now, as we speak in today's July 30th, 2025, we're at market multiples that are rivaling the dot-com craze right now. We're not in any kind of euphoria as far as I can tell, but those multiples are still really, really high.
Yes.
There is no data anywhere that says a multiple is correlated to short-term market returns. So for the next 12 months, we could be up 40%, we could be down 20, who knows? It's literally a roll of the dice. What does tend to predict short-term market moves is relative strength and momentum, which is up right now. So we would lean into that a little bit. If we're going to place a little bet, even though we're expensive, I'm going to be leaning into the markets a little bit. Warren Buffett again would say, we don't know what's going to happen in the next year, but in the next longer period of time, what the data says is if you look out 5 years from these multiples, we have never had good cumulative returns. It's never happened, ever. So would I bet that it's going to happen now? No. I think the expected value when you run regressions, it's about 5 to 6% annualized S&P returns. So if we have 40% up, we're going to get some pretty bad numbers at some point in the next 5 years.
Yes.
That's how Warren Buffett made his money. AI hasn't predicted any better in the short term, so we would look for disconnects, basically, is what you're talking about. Where is the market disconnected? And at some point, that disconnection returns back to normalcy. Are we way overvalued? At some point, it's coming back here. Are we way undervalued? Like in 2007, 2008? Again, when Buffett bought $10 billion worth of stock and did a deal with Goldman Sachs, he was a few months early. Too bad. Now, 10 years later, made a boatload of money, right? So that's what works right now is you find a disconnect, you wait it out, more or less.
So, Stuart, what would you tell our audience today? You just mentioned, where to find the disconnect because we know that there will be a rebalancing over time. We don't want to get into the disconnect where it's overpriced but underpriced. That's better. But what would you tell our audience today if they are thinking about investments in the market? And the reason I'm asking this question is because we see all those get rich quick. I won't call it how it is, but everybody wants to sell you miracles. But there are no miracles in the stock market.
No.
So what would you tell our audience for their future when it comes to the stock market in terms of what should they wait for or be prepared for when it comes time to invest?
Yeah, I think the phrase is really get rich slow, right? You're not going to get that get rich quick. If you have something and somebody tells you they're going to get you 20% returns or 30% returns or something year over year and it's not going to have any risk, there's plenty of money out there that's going to pile into that particular investment that would be dying to get into that investment. It just won't exist. Like, it just won't exist. I've had friends and clients of mine say, hey, well, I want to buy this real estate or I want to do this. And yes, you can make money in anything, whether it's real estate or gold or currencies or, pick a thing, you can make money. If you're being promised 20 or 30 or 40% out of market rate of returns for low risk, it's just not, it's too good to be true. It's just not available. So you're either unaware of the risk that's out there, or you're just not going to get the returns that are promised. One of the two.
Yeah.
And so what I would tell them is you want to get rich slow, and you want to do it within your own risk parameters. Because the worst thing that could happen, and I'll say this to my clients all the time, they all want to be highly aggressive when the market's moving up. And when the market's moving down, I want to be back to my normal level of risk and comfort. I don't want to lose any money. Well, that's great. Okay, we do try to time the market to some extent, and there are some tools that help with that. But again, you're not going to be perfect. You're not getting out at the top. You're not getting in at the bottom. You're going to be taking risk. So if let's just say you were trying to ride up this market and you took on a lot of risk, and then the market turned around and dropped, and you being the client, felt so much pain that you had to get out of the market, that's called capitulation.
Yep.
And if you're doing it, probably a million other people are doing it at the same time. They're all feeling the same pain at the exact same time. If you're feeling that pain, so is everybody else. And there's blood in the streets. It's literally when Warren Buffett's stepping in. I know I've mentioned his name a lot. And when you're getting out. And the problem is when you get out at that time, that's often the bottom. So now you've ridden it all the way down. You gave up, you took on too much risk, or I, as your financial advisor, allowed you to take on too much risk, and you got out. Then the market, kind of around that point in time, turns around. So let's say it rallies 5 or 10%, and I say, hey, would you like to get back in the market? No, it's up 10% off of its lows. I would be crazy to get in the market.
Yeah.
Okay, so you're waiting for a pullback. Let's say it pulls back below your lows. Okay, now do you want to get in the market? Well, no, the market's falling. Okay, so we'll stay out. Then it rallies back up. Do you want to get in now? No, it's off the lows. Okay, when are you buying back in? What happens is once it finally gets steady and goes up, 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 then you stop. I can't take the pain of losing the opportunity now. I'm going to get back in. And it's often, again, a bad time. So you either have to be disciplined with your risk parameters so that you're not out at some of these awful events. And let's frame this, every 7 to 10 years, the market's going to lose 50% of its value. This is history. So if I'm coming up on 60 years old. Let's hope I live to be 80. I'm going to see this 2 or 3 more times in my lifetime.
Yeah.
If you are not comfortable with losing 50% of your 401k and all of your assets every 7 to 10 years and riding it back up, then you need to adjust your risk.
Yeah.
So I would say make your assets slowly within your own risk tolerances.
Thank you, Stuart. Well, this is the closing of our discussion. I appreciate you coming on and giving some advice and discussing the financial markets with us. Stuart, have a great day and thank you very much again.
Thanks so much for having me, Richard.
Bye.